All right, let's talk about Matrix Service Company, ticker MTRX. They just had their Q4 earnings call, and wow, it was a wild one. You had management on one hand painting this picture of a really strong business underneath, but on the other hand, you had the market just reacting with a massive sell-off. So we're going to get into it, and we're going to figure out what on earth is going on here.
And I mean, this is what I'm talking about. The second those numbers came out after hours, the stock just plunged. A 15% haircut, just like that. Investors weren't even waiting around for the conference call to hear the explanations. They were selling, and they were selling fast. You know, a move like this, it just screams that there was a huge disconnect between what Wall Street was expecting and what the company actually delivered.
So this really brings us to the big question, right? Is this just a noisy quarter? You know, one of those quarters that's messy because of a few one-off problems that are kind of hiding an otherwise pretty healthy company? Or is this a sign of something worse? Is this a broken story where these execution problems are starting to become a pattern? That is exactly what we need to unpack. To get to the bottom of that, we first have to really understand the miss itself. So let's break down the numbers and see exactly where things went wrong. And wow, the size of this earnings miss is really what jumps out at you. I mean, analysts were looking for a small profit, right? 2 cents a share. Instead, the company comes in with an adjusted loss of 28 cents. That is a 30-cent miss. Huge. And on top of that, revenue also came in light by about 16 million bucks, missing on both the top and bottom line. Yeah, that is never a good look. This number right here kind of gets to the heart of the problem with profitability. Their adjusted EBITDA was negative $4.8 million. You know, in a business like this, you have to be generating positive cash from your actual operations. And this number tells you that in the fourth quarter, the core business, it was losing money. Plain and simple. So you're probably asking, where did all the money go? Well, management pointed to these 4 specific things. You've got a hit from an old legacy project, a productivity charge on another one, some restructuring costs, and then a court ruling that didn't go their way. You add all that up, and these 4 items basically slammed their net income by almost $15 million. This is really the foundation for their whole "it was just a noisy quarter" argument. Okay, so we've seen the damage. Now let's switch gears and look at what management had to say for themselves and why they're arguing that the future is still incredibly bright, even after this really ugly quarter. This quote from the CEO, John Hewitt, from the earnings call, this is their whole message in a nutshell. He's basically telling investors, hey, look past these 4 weird items. These are old issues and one-time costs. The real day-to-day business is actually doing great. And this sets up a classic Wall Street standoff. You know, it's a real tug of war. In one corner, you've got management's bull case, a massive $1.4 billion backlog, some really strong guidance for 17% growth next year, a super clean balance sheet with 0 debt, and a newly streamlined company. But in the other corner, you have the market's bear case, a major hit to their credibility after this miss, the fact that these so-called one-time issues keep popping up, some macro uncertainty out there, and of course, the fact they just lost money. So this whole conflict, this battle between the bulls and the bears, it really all comes down to the future. So let's pivot again and take a hard look at the company's guidance and ask ourselves, is this for real? Is it realistic? And you got to give them credit. Management is not hiding. They came out with some very strong revenue guidance for fiscal 2026, between $875 and $925 million. I mean, at the midpoint, that's 17% year-over-year growth. After the quarter they just had, that is a really bold forecast. So you might be wondering, how can they be so confident? Well, the answer is the backlog. This is the crucial point. Management said that about 85% of that revenue they just guided to is already booked. It's secured. These are projects that are already, as they said, in full flight. So that takes a lot of the risk out of that revenue forecast. And here it is. This is the entire debate summed up in one single question. Okay, great. They might hit the revenue number, but can they actually make money doing it? After a quarter where they had a big charge for, and I'm quoting here, lower than anticipated labor productivity, the market is absolutely right to be skeptical. The whole story has shifted. It's not just about winning new jobs anymore. It's about proving you can actually execute them profitably. So let's put all the pieces together. What does this all mean for the stock? And what are we looking for on the next earnings call? Here's our take. You know, the core tension here is crystal clear. The bulls have a really strong case with that huge backlog and that clear guidance for growth.
But the bears have an equally strong case with the execution risk and the fact that, frankly, credibility has been damaged. From where we stand, the company has basically used up all its hall passes. The burden of proof is now 100% on their shoulders. They have to deliver a clean quarter. No excuses. So our first prediction is that the stock is probably going to face more pressure in the near term. You know that saying, trust is earned in drops and lost in buckets? Well, after a drop this big, investors are going to be in a wait-and-see mode, and that's likely going to keep a lid on the share price until they see some real, tangible proof that things are turning around. So, what does that mean for the stock price? We see it being pretty much range-bound for a while. It's kind of stuck, And that's exactly why our rating is market perform. That massive backlog, it provides a pretty solid floor under the stock, so we can't really call it an underperform. But that big blow to credibility and the obvious execution risks, well, they create a ceiling on the price, making an outperform rating just impossible to justify right now. At the end of the day, this is a show-me story. Until management can deliver a clean quarter, you should probably expect the stock to just perform in line with the broader market. And that's our take on MTRX. Now, as always, it's really important to remember, the analysis in this explainer is just for informational purposes. This is not financial advice.